We are also getting different opinions about the direction of the stock market. BlackRock's chairman and CEO Larry Fink said this morning that he believes investors need to stay invested.
We saw people de-risking still, and I still believe, as I said last quarter, I think this is going to be a mistake. People are underinvested in equities. And I do believe with now the changes of tone of central bank behavior, and you're starting to see corporate earnings are coming in pretty well. You know, we still are constructive on the world.
But on the other side, the chief investment officer at Morgan Stanley, Mike Wilson, said he feels investors should be patient and wait for a better time to invest. So tonight we bring together a stock market bull and a bear to get their respective views. Our bear is Phil Blancato. He's CEO of Ladenburg Thalmann Asset Management. And our bull is Ken Kamen. He's president of Mercadien Asset Management. Good to see you both. Thanks for joining us tonight.
Thank you.
Bull, make the case. Why now?
Well, I mean, the market certainly has been doing very well. You know, the old adage, don't fight the Fed, is always been a good bullwether to look at, although I think there are some reasons to question whether we really do need the rate cut. So that's a little bit different point of being a bull, because I do think it'd be probably better that they wait to September, keep it in their back pocket. And I do have to say that I think that is some risk for the market. But I have to tell you, the market doesn't really look that expensive. When you think about January of 2018, the market was trading at about an 18.5 times forward earnings, with earnings estimates now on a forward basis down 6% from when they were a year ago. We're only at about 16.5. So it doesn't really seem that expensive, and it's more towards the averages, I think, historically.
Phil, you were with us the other night, made the case for being cautious in this market. So we're calling you a bear tonight, but make that case again. You see a slowdown in the economy, and the trade tensions are causing some problems as well.
There are really, to me, a number of things that are greatly concerning. First off, the Fed cutting rates doesn't mean the economy is going gangbusters. So that's obviously a bad sign. So we have become far too reliant on the Federal Reserve to drive the markets higher, and that's of great concern for me. You've got earnings for the first 2 quarters are going to be only very modestly positive. So how do you, in my opinion, stocks are expensive? I wouldn't agree. I think stocks are trading at 19 times with their traditional earnings around 17 times. So stocks are not cheap, and you don't have earnings to lift the prices or the earnings up to justify the prices. So a slowing of the economy. Today, leading economic indicators came out showing a significant slowdown in the economy, flat earnings, and the Fed having to come in and rescue us. Those are not the signs of being bullish on stocks.
What do you think?
Well, I think that, you know, first of all, you have to say, are we looking to try to make a trade for the next week or two, a month, or is this investing for the longer term? I've been doing this network for quite a long time now, and I get called in when the market's down, and our message is always, you know, ride through it. You have to have a long-term plan. You have to know how this fits in with your overall planning. Well, it should be the same thing when the market's high also, that if you have a good allocation and you know where things are, that you shouldn't necessarily be afraid of you know, markets at tops. I've been around this industry long enough to know that tops cause as much anxiety as they do jubilation. But right now, I'm really not that fearful. I think that, especially if we do get the Fed rate cuts like people are expecting, I think there's some, you know, life left in the bull.
What about that? We do have a lot of long-term investors who watch this program. So what do you say to them here?
This is a great time to go neutral. You've made so much money. Take 5% out of your equity holdings. Maybe take 10. Earn a little profit. Such short-term fixed income investments that are yielding 2.5%. You could take a little bit of excess off the table, put it in the short term. And by the way, to your point earlier, if the Fed doesn't cut, and I'm in the camp where I don't think the Fed cuts, I think the data is still good enough to hold on. The market will go through a real tantrum here. So don't put in a situation where you can really get penalized by overthinking this.
Who takes us higher then, sector-wise? I mean, technology's been the go-to, healthcare's done well. Are those still the sectors to take us there, or is it something else?
Well, I think if we get something from the president on trade, it could be international starting to catch up. I mean, because that's really been lagging for quite a bit. I just have to kind of point out that I think if you've been in a well-diversified portfolio all along, it's hard to say I've already been taking maybe 40 or 50% of my portfolio and earning 2%, then I want to take more of it and put it there. I get the idea of being defensive, but that's why you put an allocation on and try to hold it. But I do think that even the financials, which really have not had the greatest time.
Right.
I mean, you got to buy things, you know, buy them when they're crying is one of the best adages I've ever heard on the market.
We'll buy low, sell high. A very gentlemanly bull and bear debate tonight, gentlemen. Thank you. Phil Blancato, Ken Kamen, thanks again for joining us tonight.
Thank you.